Welcome back to Financial Market Insights for Traders. I'm your host, Sophia, and today we're diving into the business model behind digital options brokers. We're pulling back the curtain to understand how they actually make money, what strategies they use behind the scenes, and more importantly, how some of those strategies may not always be in your favor. If you've ever wondered why your trades feel like they're going against you a little too often, or why that winning trade wasn't as profitable as it should have been, this episode might offer some clarity. Let's start with the foundation. How do digital options brokers operate? The two business models, market maker versus exchange. There are two primary models in this space, the market maker model and the exchange model. 1. The market maker model, also known as the house model. In this setup, the broker is literally your counterparty. When you place a trade, say, a call option on euro to US dollar, the broker takes the other side of that trade. If you win, they pay you from their own pocket. If you lose, they keep your money. Now, let that sink in. There's an inherent conflict of interest here. The more traders lose, the more the broker gains. Some brokers in this model operate fairly, but others? They've developed subtle and not so subtle tricks to tilt the odds in their favor. So, how do they manage their risk? They hedge against large traders, tweak payout percentages, and even profile traders to determine how profitable or dangerous they are to the broker's bottom line. If you start consistently winning, you may suddenly experience trade delays, slower execution, or suspicious platform lags. Coincidence? Maybe not. 2. The exchange model. Now, contrast that with the exchange model. In this setup, traders trade against each other, not against the broker. The broker simply acts as a middleman, facilitating trades, taking a commission, and stepping aside. No conflict of interest. No secret war room trying to figure out how to beat you. Exchange-based platforms are much fairer, but they're also less common, mostly because the market maker model is far more profitable for the broker. So how exactly do digital options brokers make money? Regardless of the model, brokers still need to profit. Let's break down how they do it. 1. Spread and commissions. On exchange models, it's clear. Brokers charge a commission per trade. Simple. Transparent. Market makers, on the other hand, rely on imbalanced payouts. If 80% of traders are betting on the market going up, they'll reduce the payout on call options to limit their risk, sometimes down to 60%, while put options suddenly look more attractive. This subtly encourages traders to shift their bets in the broker's favor. 2. Slippage and delayed execution. Ever hit buy, and the trade opens at a worse price than you expected? That's slippage. Some brokers introduce intentional delays in execution to create these tiny price differences. And those small differences add up, especially when multiplied across thousands of trades. 3. Withdrawal hurdles. This one's classic. You finally string together a few winning trades, try to withdraw, and suddenly you're hit with KYC issues, strange fees, or technical problems. Sometimes withdrawals are delayed just to frustrate you into placing more trades, ideally losing ones. Some brokers even go as far as attaching strict terms to bonuses, requiring huge trade volumes before you can cash out anything. 4. Bonus bait. Speaking of bonuses, ever seen a platform offer a 100% deposit bonus? Sounds great, until you read the fine print. Many brokers require you to turn over the bonus amount 30 times before withdrawals. Most traders don't even come close. So let's recap the dirty tricks some brokers use. Price manipulation, artificial slippage, platform freezes, unrealistic marketing claims, withholding withdrawals behind red tape. So what's the safer bet? That brings us to a critical point. Should you be trading with a market maker broker at all? Not all market makers are bad, but the system inherently puts you at a disadvantage. If you want fewer games and more transparency, the exchange model is the smarter option. Exchange-based brokers don't profit from your losses, have no reason to delay or manipulate trades, are usually regulated, operate like stock exchanges, matching buyers with sellers. And that's the key regulation. It doesn't guarantee perfection, but it drastically limits the shady tactics brokers can use. Always verify your broker's regulatory status. Check the license. Read user reviews. Test withdrawals before depositing large amounts. Final thoughts. To wrap it up, let me give you the hard truth. Not all brokers are on your side. If your broker profits when you lose, that's a massive red flag. Your goal is to win. Their goal is to keep you losing just enough to keep playing, but not enough to cash out. That's why understanding the broker's business model is crucial. The more you know about how they operate, the better you can protect yourself and trade smarter. If you're looking for a broker that aligns with your interests, offering transparency, competitive payouts, and no funny business, check out crystalballmarkets.com. They're exchange-based, regulated, and focused on helping traders grow, not taking the other side of their trades. That's it for today's episode of Financial Market Insights for Traders. I'm Sophia, and I hope this deep dive into how brokers work helps you make sharper, safer trading decisions. Until next time, stay informed, stay disciplined, and as always, trade smart.